Thank you for asking me to speak today. It was a bit difficult not knowing ahead of time what everybody was going to be speaking about and what Nina was going to bring up. So I thought what I might do is just start with a gentle reminder about some of the main facts about CNAV funds. And sometimes we often forget these things once we get embroiled in the 800 amendments and the debate. So Nina did mention CNAV money market funds represent about 50% of money market funds in domiciled in Europe, about 450 billion euros. If we add in the VNAV, it's a much larger industry. Our customers include non-financial corporates, pension funds. In fact, the largest group of customers is non-financial. They represent various areas across Europe and various entities. We invest in charities, SMEs, public sector, like the French social security system. We clearly also invest in financial institutions, both in Europe and abroad. CNAV money funds are, contrary to what I believe others are saying, are not banks. If you were at this last year, we had a big discussion about the term shadow banking. It's kind of like dark pools. It's really not a nice term. We don't stand in the shadow, but we aren't banks. We don't do maturity transformation. I admit that we offer same-day liquidity and place investments longer, but we're not placing our investments on a 3 to 5 year or even 20-year horizon. The majority of our investments are placed out for about 30 days. It's a bit difficult to say that's a maturity transformation. Our assets match our liabilities and our funds aren't leveraged. Again, this is very much unlike the banks, which can go 20 to 25 times leveraged. And finally, the customers or investors looking at these products want stability, rapid access, and safety. So a euro share is worth a euro share. They want access to the funds on the same day, and they want diversity of investments and credit quality. So now that I've taken you through some of the facts, I think we can then move on to how money markets work on a daily basis. Again, often when we get into these 800 amendments, and I have read them all, sadly, we forget how a money fund works. So I thought if we reminded ourselves of how they work. Nina's left, but that is her town hall of her local authority. Last time I think I used Brussels. So a local government treasurer has 10 million euros. In this case, clearly it would be in the UK, so it would be sterling. And she wants to put it somewhere for a short period of time. She needs easy access and safety, as I'd said before. So all that she does is buys 10 million shares in a money market fund, each worth €1. The fund is now worth 10 million euros, and this is what we call the net asset value, or what you'll often hear people say is NAV for short. And here comes the slightly complicated bit, but I really don't think it is. What then happens is the fund manager, my team back in the UK, would invest that 10 million in a highly diverse portfolio, including, for example, a COS, that's the French social security system, Lufthansa, I don't think I need to tell you who that is, and the Kingdom of the Netherlands. And these are actual examples of investments that we would do. We invest it, this continues throughout the day until the entire 10 million euros is spent. We will diversify as much as possible, no more than 5% per issuer. Clearly the number doesn't add up to 10 million, but if I kept doing that, we'd run out of space. When we lend the money to Lufthansa, for instance, we will have a charge to them and we will lend them for a certain period of time. The fund is now shut at 1 o'clock in the afternoon, and we need to calculate the return for the local government treasurer, and this is known as the income. And quite simply, in a money market fund, this is where amortized accounting comes into play. It is an internationally recognized way of valuing an asset, and it really isn't that scary. What happens is, the assumption is that we would hold all of these three assets until the 30th day where our return would be paid, which you can see in this column here. The total income due in this case would then be 40,000 euros, which would be paid to us on the 30th day. Because we declare the income or the investment to the treasurer on a daily basis, we divide the 40,000 euros by the 30 days, which is the duration, and every day we would give the treasurer 1,333 euros. That's known as the daily income, and that can be done because you amortize the asset. Again, your assumption holds that you hold the asset for the life of it. We then need to talk, we've now done the income, and now we need to talk about the price of the share, and this is where the constant net asset value comes in. The principal is at 10 million, and we divide it by the number of shares we've given to the treasurer, which is 10 million, and the number comes out as 1. And that basically is as simplistic as it is. The income is declared or parked for the treasurer each day. We don't tend to pay the income out on a daily basis. Should a treasurer request it, it can be done. But what then happens is a dividend's paid at the end of the month, and then the money, we start all over again. So this entire process happens on a daily basis. We take the income, we park it, we divide the principal by the number of shares, and this is how we constantly get one. Hence, it's known as the constant net asset value. So hopefully you see how these work and how simple they are. There's no bells and whistles. They're not complicated. I think often people try and complicate them in ways that they shouldn't. Now, Nina did touch on this, so we took a look at where we believe there is consensus. And this really is consensus amongst MEPs, national authorities, the industry, and the investors. We all agree that we need some kind of enhanced regulatory framework with a single regulator. ESMA is the one that is put on the table at the moment, and I believe the industry would be happy to accept ESMA, as long as ESMA felt that they would be happy to take us on. But it's definitely a point that there is full consensus on. Transparency, the more the better. We all agree with that. I think often people think we're trying to hide something. We don't. We publish everything. You could look at our holdings on a weekly, daily basis, should you want to. And again, the industry, authorities, investors all like that. Interesting, Colin brought up the question, a level playing field. The industry, in the main, is agreed that a level playing field must be had between CNAVs and VMATs. Fundamentally, we are the same. On the pricing, we aren't, but the investments that we do are similar. They're both trying to achieve the same thing, and therefore we need a level playing field. So if we declare them both to be systemically important, then we need to make sure what we put in place goes for both. And finally, consensus is a minimum amount of liquidity. When I typed this out, I thought minimum doesn't quite sound right, but minimum, this would be across all funds, and this wouldn't be a low number. This would be a sort of a 10% on a single day, up to a 30% over 7 days. You won't find anyone in the industry who disagrees with that, and you won't find any of our investors who wouldn't have a problem should we do that. Clearly there's consensus, as Nina had talked about, and I've listed here, but there are still areas that are being debated. I don't envy Nina's job of going through those 800 amendments and picking and choosing them. So these are the areas that we feel are under consultation. One is the types of investors who can come into a specific fund. Should we have a carve-out for various types of investors? Should we allow that to happen? Some say yes, some say no. The types of investments that can go in it. Should we limit the types of investments that can go into various types of funds? Some say yes, and others, again, would be saying no. Nina didn't touch on the involvement of the rating agencies. Should we be rated? Should we be allowed to be rated? Some, again, say yes, some say no. How much reliance should we put on them when we're using rating agencies in the analysis of the investments? And finally, a big one as well is, should firms be allowed to have some support in times of market distress? And this is a very polar question. It comes out generally with an absolutely or an absolutely not. So what we've done is we've put together some of the responses to this, reminding ourselves that the objective of these funds is to create a safe and stable, accessible marketplace and to help fund the real economy. Okay, so these are some of the proposals that are out there. Public debt CNAV. I think we can deliver a public debt CNAV. This can happen. However, we will need to broaden the number of available countries that are of use. Currently, the number sort of flips between 6 to 8 countries in Europe that we could invest in. Again, that would assume that they issue in all 3 currencies that these funds are used in. So in particular, quite a few of them wouldn't issue in sterling, I understand completely. Some may not issue in dollars, and others will definitely in euros. If we broadened it to the G20, that would give us a bit more of a base and would also help to diversify. Remember, we want diversity in these funds so we're not hit at any one time. The buffer. I'm not a fan of the buffer, and I think it should be removed. 3%, first of all, it would take a lot of capital out of the market. We remind everybody again, assuming the banks had to withdraw 10 billion of capital to put in as buffers. If your average bank gears 20 to 25%, that's a withdrawal of 200 to 250 billion euros into the system, when clearly various areas within Europe, in particular the ECB, is pumping liquidity into the system. We don't want to be withdrawing it. It would also be a hard sell for me to go back to, and I think my peers, to go back to our parents to ask for money to sit in a financial institution that could then potentially be bill-inable. So from an economic perspective, it isn't economical for us. But we think public debt could work if we broadened the public debt that was in it. And so if we move on from that, how do we create an accessible, safe market for the retail investor? I think the problem that we've been having with this topic is that the EU retail investor is not the same as a retail investor as defined in the United States and by the SEC. EU retail investors, in my experience, and I've been doing this for a long time, are the most likely to run. They are the least stable. They currently benefit from the stability of pension funds and corporates who invest in liquidity funds, so they get the buffer that sits there. So therefore, they can withdraw their smaller amounts of money. We find that pension funds are the least likely to run. It takes a pension fund quite a long time to determine what it's doing, and they are less likely to react to shocks in the market. So we think if you want to provide a safe and stable marketplace for retail, that if you extend Nina's definition of retail to include at least pension funds and those corporates that are stable, then you would have a CNAV fund available to charities, SMEs, and local authorities. And so what do we do for the rest of the investors? We think that corporates, I know Colin has mentioned it, corporates may exit the market if there wasn't something available to them. Fine, you may say, but they do represent a large proportion of the market. Just as an interesting fact, the retail investor as defined now in the amendments represents 7% of the investors in liquidity funds, 7. So therefore you have 93% representative of something else. Corporates represent about 20 to 22%, but they are in size quite large in comparison to small local authority. They can move faster and quicker, so we believe that they would leave the CNAV market, not necessarily move into a VNAV, but may switch into segregated accounts or higher risk alternatives. As Colin said, these are professional investors for their treasury cash. So we think that we should be allowed to include corporates in either a retail or a CNAV on its own. And finally, this is a bit of a hot topic, and we, at Legal & General had to make a decision as to whether we were going to support, whether we had support in the funds or not. And we believe that we should be able to access support in times of distress. I should emphasize this is not taxpayer support. This is not national authority support. We believe that there should be implicit sponsor support that is transparent and well-defined. The support should be with agreement by the board, the national regulators, national competent authorities in advance of it being used. Should only be used in times of distress, which are clearly defined. So it is a conversation that you would have with your competent authority and the regulator. We have gates and fees, and they're part of the solution, but we think we need a bit more. So examples of some types of support that could be used would be asset purchases by the sponsor at a distressed price, unit or share purchases that come in at a different level, an insurance policy, often like a credit default swap, that could be drawn on in a time of distress, or a retention of yield. We would suggest that different houses may opt to use different things because we all have different business models, but if you allowed support in times of distress that is clearly defined, then we think that it is something that can be considered. So hopefully I've been able to kind of take you back to the beginning with a few key facts about funds, why our clients like them, how they work, and why we think if we do increase and work with some of Nina's amendments and add a few other bits in, that we can provide a safe and stable environment for investors and also continue to provide funding for the real economy.
Thanks very much.